So here we are again, starting with differential analysis. And as mentioned in a prior video, we're going to be looking at examples of all of these where we, as a business, are trying to decide between the two alternatives. And not just making a decision, but looking at the financial impact of our decisions, okay? All right, so the first one we have on docket is leasing or selling equipment. So before we get into like the example of it, I want to let you know that how does this even come up? So management may lease or sell a piece of equipment that is no longer needed, right? So maybe they have updated their manufacturing process, or whatever the case may be. Maybe they bought a new piece of machinery, which we'll talk about later. But yeah, they updated their manufacturing process, and now it does not include that piece of machinery anymore. And so now they're trying to decide, do I lease or do I sell the equipment? Okay. So let's take, for example, this information. So we have here, maybe you want to pause the video, but here it is. We have the cost of the equipment is $200,000. We have accumulated depreciation and a book value. And then here in the next parts is our alternatives. So alternative number one is we can lease out the equipment. So it's telling us if we lease out this equipment, the total revenue for a 5-year lease is $160,000, but we need to make sure we estimate the repairs, insurance, property taxes, and all of that, which is $35,000. And then there's no residual value at the end of the 5th year of the lease. Or alternative number two, or decision number two, is we can just sell the equipment, right? So the sales price, if we decide to sell the equipment, we would sell it for $100,000, and then we would likely have to hire somebody to help us sell it. So the commission on the sale of that equipment is 6%. Now, here's where we're going to apply differential analysis, right? Trying to decide which one is the best case for us, which one will yield the most amount of revenue, okay? All right, so this is what it will look like. So in column number one, So in column number one, we have the lease equipment, which is alternative number one. So the revenue is $160,000, which was already mentioned here. And then the cost is the $35,000 for us to repair it, to keep insurance on it, and all of that. So our income from that lease is our revenue less our cost, which will give us $125,000. Now, alternative number two is to sell equipment outright. Instead of being a lease of this equipment, we're just going to sell it and be done with it. So again, that comes from here. It told us that our sales price of the equipment is $100,000. The $6,000 is the 6%, right? So if we did 6% times 100,000, we come up with 6,000. And so our income from the sale of that equipment is 94,000. All right. So in column number three is where you do the differential, where we compare alternative number one to alternative number two. And so don't forget, in doing this, you need to do alternative number two minus alternative number one, right? So we do 100,000 minus 160,000, and we get 60,000, so forth and so on. So in looking at this particular example, if you own this equipment, which decision are you going with? So hopefully you maybe took a second to read through this, but your decision, or you should go with leasing it, right? Because if you decide to lease it, you get the most amount of money. You are getting $31,000 more by leasing the equipment versus selling the equipment, okay? So hopefully that made sense to you. So before I move on to like an example, in my prior job, I had the experience of, do we lease or sell equipment? But it was more so from the perspective of cold storage space. So in Southern California, there is a lot of people looking for cold storage to store like refrigerated things like meat or protein or whatever the case is, right? There's, for some reason in Southern California, California, there's a shortage of cold storage. And so I was working for this company where we were actively trying to decide, hey, is it more profitable for us to lease out this cold storage space versus have our own inventory there? And so we wound up figuring out that, hey, it makes us more money. It's more lucrative to store stuff for other people than to hold our own inventory. And so we're making a ton of money from that decision, and it wasn't our main business. Okay, so that's how that concept of leasing or selling or things like that comes into play. All right, so let's put this all into practice now. Okay, so take a second to read through this example, and then I will clear this screen and we'll go through this example together. Okay, all right, so pause it, watch it, read it, and then see if you can come up with a differential analysis. All right, so welcome back. So we have McFadden Company owns equipment with a cost of $475,000 and accumulated depreciation of $280,000 that can be sold for $175,000, less than 7% sales commission. Alternatively, McFadden Company can lease the equipment for 4 years for a total of $180,000, which there's no residual value at the end. In addition, the repairs, insurance, and property tax expense would be incurred for a total of $35,500 over the 4 years. So we're trying to decide which one is the best one to go with, right? So with that, let's see. All right, so here is our differential analysis, and I've already kind of took this and made it all pretty and set it up. So alternative number one is to lease the equipment. So we're going to fill this out together. So our first one is going to be revenue, our cost, and then we have our income or loss. And now from here, we're going to set in or put in the information. So if we were to lease the equipment, it told us that we could get a lease for 5 years for $180,000. The cost will be $35,500, which was here, right? All right, so then next we're going to do the income or loss. So you do your revenue less your cost, and we get our income of $144,500. Now, if we decide to sell this equipment outright versus leasing it, it told us that our revenue from selling this equipment would be $175,000. Now, what's really important to note here is that yes, you bought this equipment for $475,000 in depreciation, but all of that information is just noise. It's irrelevant to your decision. Now, here's the reason it's irrelevant to your decision. There's this thing called sunk cost. I'm going to write it on the screen. There's this such thing as sunk cost. And sunk costs are costs that have been incurred in the past. It cannot be recouped, or you can't get the value back, and therefore it's not relevant to any future decision. So again, you bought this equipment for $475,000. There's no way you're going to get that same value back from that equipment, right? So it's like buying a car. Yes, you bought that car for maybe $35,000, but because it's depreciated over time, you're never going to get the full amount of the value back, right? So the original cost and that depreciation is all a sunk cost. It's irrelevant to you, right? So that's why we're not including that $475,000 nor the depreciation on it. All right, so our next one is our cost. It told us that our cost, if we was to sell it, is 7% of the sales price. So if it costs if we can sell it for $175,000 times 7%, that comes out to $12,250. And now we're going to find out our income from the sale of it. So it's the revenue less our cost equals that. So now from here, we're going to do the differential effect on income. So again, we're going to take alternative number 2 less alternative number 1, right? So we get 5,000 here. So 175 minus 180 is a negative 5,000, our costs, and then here. So with that in mind, if you're looking at these two alternatives, which one are you going to go with? Are you going to sell the equipment or lease the equipment? Which one would yield the most amount of money to you? So hopefully you said you're going to sell this equipment because, again, it will give you the most amount of money. If you decided to sell this equipment versus lease it, you will make $18,250 more by selling it versus leasing it, okay? So again, hopefully that all made sense to you. That's the whole concept between differential analysis when it comes to leasing versus selling equipment, okay? So, okay. All right. So now with that, we're going to get into, now we're going to get into discontinuing an unprofitable segment. So in the next video, that's what